If you only looked at Transcorp Power's headline profit, you'd probably think this was another excellent quarter. The company made almost 38.5 billion naira in profit after tax. Its operating margins actually improved. Management maintained its dividend, and on the surface, the business still looks incredibly profitable. But buried inside the cash flow statement is one number that completely changes the story. A negative operating cash flow of 5.6 billion naira. Think about it. The company reported almost 40 billion naira in profit, yet its day-to-day operations actually consumed cash instead of generating it. How is that possible? Is Transcorp Power's profit misleading? Is something wrong with the business? Or is this simply the reality of operating inside Nigeria's electricity market? By the end of this video, we'll answer those questions, and more importantly, we'll know whether Transcorp Power still deserves investors' capital today. Let's go behind the numbers. Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required. Today, we're looking at Transcorp Power PLC's unaudited second quarter 2026 financial results. Transcorp Power isn't a small speculative company. It's one of Nigeria's largest listed electricity generation companies, supplying power from its Ughelli plant into the national grid. For years, investors have viewed it as one of the stronger names in the power sector because of its consistently high profitability and generous dividends. But this quarter presents a much more difficult story. By the end of this analysis, we'll know exactly what the numbers say. Let's begin where every good investment analysis should begin. Is the business itself still growing? We'll start with the most obvious place, revenue. Because before we worry about profits, cash flow, or dividends, we first need to answer a much simpler question. Is the business actually selling more electricity than it was before? Unfortunately, this is where the first warning sign appears. Every major profit measure moved in the wrong direction. Revenue fell by almost 12%. Gross profit declined, operating profit declined, profit before tax declined, and profit after tax fell even further, dropping almost 13%. This isn't the pattern we'd expect from a company whose business is expanding. So naturally, the next question becomes, why did revenue fall? The answer becomes clearer when we look at the main sources of revenue. 1. The capacity charge. This is the payment Transcorp Power receives simply for keeping its generating plant available to supply electricity. It fell by almost 22%. The other is revenue from electricity actually delivered into the grid. This also declined, although by a smaller 8%. When both of your main sources of revenue are falling at the same time, it suggests the slowdown isn't coming from one unusual event. It's affecting the core business itself. Now, despite those falling revenues, something interesting happened further down the income statement. Profit didn't fall nearly as much as sales. Why? Because management did an excellent job controlling costs. We see this in the margins. Even though the company generated less revenue, it managed to protect and even improve its gross and operating margins. In simple terms, the company squeezed more profit out of every naira of revenue than it did a year earlier. That's a genuine operational strength. But it wasn't enough to fully offset the decline in sales. Another factor also weighed on the earnings. The company's effective tax rate, which is simply the share of profit that actually goes to tax, increased from 25% to 30%. That higher tax bill meant profit after tax fell almost twice as fast as profit before tax. So where does that leave us? The company controlled costs well enough to preserve margins during a difficult period. But the bigger problem remains. The business itself generated less revenue than it did a year ago. But declining revenue isn't the only question these numbers raise. Can we trust the profit that was reported? Because buried inside these results is an accounting adjustment that questions the quality of this quarter's earnings. As we've said many times on this channel, not every naira of reported profit tells the same story. Sometimes profit comes from selling more electricity. Sometimes it comes from controlling costs. And sometimes it comes from accounting adjustments that may never generate a single naira of new cash. That's why we always ask the same question. Can we trust these earnings? The first clue appears below the operating profit line. Buried in the notes is an item called an impairment reversal. That sounds technical, but the idea is actually quite simple. Imagine someone owed you money. Last year, you became worried they might never pay, so you recognized that money as a likely loss. Now suppose this year they eventually start paying. Instead of recording new income from selling more electricity, you simply reverse that earlier loss. Your reported profit increases, even though you haven't generated any new business. That's essentially what happened here. The company reported almost 55 billion naira in profit before tax, but about 2.2 billion naira of that came from reversing an earlier impairment provision. Remove that accounting benefit, and underlying profit falls to roughly 52.8 billion naira. The company remains highly profitable, but the decline compared with last year becomes noticeably larger than the reported profit suggests. On paper, profit before tax fell about 6%. Without the impairment reversal, the decline is closer to 10%. That's an important distinction, because investors trying to understand where a business is heading care most about what the underlying operations produced, not what accounting adjustments added afterward. The impairment reversal wasn't the only reason earnings looked resilient. Finance costs, the interest the company pays on its borrowings, also had a much smaller impact on profit than they did a year earlier. We'll come back to that when we examine the balance sheet and how management financed the business. So what should investors conclude? The profits are still real, they just aren't quite as strong as the headline suggests. But earnings quality isn't judged by accounting adjustments alone. There's an even tougher test every profitable business has to pass. Did those profits actually become cash? And this is where the story changes dramatically. Despite reporting almost 38.5 billion naira in profit after tax, Transcorp Power generated negative operating cash flow of 5.6 billion naira during the first half of the year. Let me rephrase that. The company reported billions of naira in profit, yet its day-to-day operations consumed cash instead of generating it. That doesn't automatically mean the profits are wrong, but it does mean they weren't backed by cash during this reporting period. So naturally, the next question becomes, where did the cash go? The answer is sitting on the balance sheet. Trade and other receivables increased by about 61 billion naira in just 6 months. Receivables are money customers still owe the company for electricity it has already supplied. In other words, the company has done the work, it has recorded the revenue, it has reported the profit, but it hasn't received all the cash yet. And the scale of this is worth sitting with. Total trade receivables on the balance sheet have now built up to roughly 529 billion naira. That's an enormous amount of money waiting to be collected. Meanwhile, the company's actual cash on hand at the end of the quarter was just 668 million naira. In other words, Transcorp Power isn't struggling to make sales, it's struggling to collect the cash from many of those sales. And the backlog has grown large enough that it now defines the company's liquidity position. That's a well-known challenge across Nigeria's electricity sector, where payment delays are common. So this isn't necessarily evidence that customers will never pay, but it does explain why profit and cash moved in completely different directions this quarter, and why this is the single biggest flag in this entire report. For long-term investors, this distinction matters a great deal. Profits can pay dividends only after they become cash. Profits repay debt only after they become cash. Profits fund future expansion only after they become cash. Until then, they remain accounting profits. So, can we trust this quarter's improvement? Yes, but with an important qualification. The company is genuinely profitable. However, part of the reported earnings benefited from an impairment reversal, and more importantly, those profits were not matched by operating cash generation. That's the biggest question hanging over these results, and it's one we'll keep seeing as we move through the rest of the financial statement. Because once cash stops flowing, everything else, from debt to dividends, starts looking very different. Up to this point, we've focused on the business itself. Now we need to answer a different question. Did the people who actually own this business benefit? Because a company can remain profitable while still creating very little value for its shareholders. The first place to look is earnings per share. Earnings per share is the company's profit divided among all the shares in existence. It's the amount of profit that belongs to each individual share. Here's what happened. For the first half of 2026, earnings per share fell from 1 naira 87 kobo to 5 naira 13 kobo. That's a decline of almost 13%. Importantly, this wasn't caused by the company issuing new shares. The number of shares outstanding remained unchanged throughout the period, so every shareholder still owns the same percentage of the business. The decline is simply a reflection of lower earnings. But look at the second quarter on its own, without the result of the first quarter, and the picture is considerably worse. Quarterly earnings per share fell from 1 naira 50 kobo a year ago to just 83 kobo this quarter, a decline of almost 46%. That's a much sharper deterioration than the half-year number lets on, and it's a signal that whatever is weighing on this business didn't ease up as the year went on. It intensified. Book value tells a similar story, although it's slightly more encouraging. Remember, book value is roughly what would be left for shareholders if the company sold everything it owns and paid off everything it owes. Think of it as the company's net worth, one share at a time. Despite the weaker earnings, book value per share increased modestly from about 24 naira 45 kobo to 25 naira 25 kobo. That means each share now represents slightly more value than it did 6 months ago. So even though profits fell during the period, the company's net worth still increased a little. The improvement wasn't dramatic, but it moved in the right direction. The third piece of the puzzle is the dividend. Management continued rewarding shareholders, declaring dividends equivalent to roughly $30 billion in total. On the surface, that's excellent news, especially for investors who rely on dividends for income. But here's where this quarter becomes uncomfortable. Remember what we discovered in the cash flow statement. The business didn't generate positive operating cash flow. In fact, operating cash flow was negative. So while shareholders still received a generous dividend, it wasn't covered by cash generated from the company's operations during this reporting period. Now, one quarter doesn't automatically make the dividend unsafe. Power companies often experience timing differences between reporting profits and collecting cash. But if negative operating cash flow continues while large dividend payments continue, management eventually faces a difficult choice: either borrow or reduce the dividend. That's why this quarter doesn't justify panic, but it does introduce a curiosity question that wasn't there before. Can the company continue rewarding shareholders at this level if cash collections don't improve? So, unlike the annual report, where shareholder value creation was clearly strengthening, this quarter suggests shareholder returns are beginning to face pressure from the same cash flow challenges we identified earlier. This naturally raises the next question. How much confidence should investors have in management's decisions during this period? Every quarterly report eventually becomes a judgment on management, not because management controls electricity demand, the Nigerian power market, or when customers choose to pay. What they do control is how they respond when conditions become more difficult. This quarter paints a mixed picture. On one hand, management deserves credit for maintaining operational discipline. Despite revenue falling by almost 12%, gross margin actually improved slightly, operating margins strengthened, and the business remained highly profitable. That tells us costs were managed well. Just as importantly, management didn't issue new shares. Existing shareholders kept exactly the same ownership stake they had before. Those are genuine positives. But the quarter also reveals decisions that deserve closer scrutiny. The biggest one concerns cash. Earlier, we saw that trade receivables increased by more than 61 billion naira during the first half of the year. Some of that reflects the reality of Nigeria's electricity market, where payment delays are unfortunately common. But regardless of the reason, management still had to decide how to fund the business while waiting for that cash to arrive. Their solution was straightforward. They borrowed. Total borrowings more than doubled in just 6 months, rising from about 31 billion naira to almost 64 billion naira. Now, borrowing isn't automatically a bad thing. In fact, if a healthy company expects cash to arrive later, taking a loan can be a sensible way to keep the business running in the meantime. The encouraging news is that Transcorp Power can still comfortably meet the interest payments on its debt. Its operating profit is still many times larger than the amount it's paying in interest. So, for now, the debt itself isn't the biggest concern. The more interesting question is what the borrowed money was used for. During the first half of the year, the company spent only about 525 million naira on buying or upgrading assets. That's a relatively small amount. At the same time, it paid shareholders an interim dividend of roughly 30 billion naira, even though it generated negative operating cash flow during the period. That suggests a significant portion of this new borrowing effectively helped support working capital and maintain shareholder distributions, rather than expanding the business. Investors may have different opinions on that decision. Some will appreciate management's commitment to maintaining the dividend. Others will argue that preserving cash until collections improve would have been the more conservative approach. Neither interpretation is unreasonable. One area where management does deserve credit is transparency. The financial statements clearly disclose transactions and balances with other companies within the Transcorp Group. That's normal for a business that belongs to a larger group of companies, and nothing disclosed here appears out of the ordinary. So, how should we judge management after this quarter? Operationally, they performed well. They protected margins despite weaker revenue, they avoided diluting shareholders, and they kept the business profitable. Financially, however, they accepted significantly higher debt, while cash generation weakened. Whether that proves to be a smart temporary bridge or the beginning of a larger financing problem will depend largely on one thing: whether those enormous receivables begin turning into cash over the next few quarters. We've now examined the business from almost every angle. Revenue is declining. Margins remain strong. Profit is still substantial. Cash flow is weak. Receivables are piling up, and debt has increased sharply. So the final question is the one every investor ultimately cares about. Has the market already priced all of this in? Or put differently, is Transcorp Power still worth buying today? Let's begin with earnings. At the current share price of 244 naira, the stock is trading at roughly 23 times annualized earnings. Here's how we got there. H1 2026 earnings per share was 5 naira 13 kobo. Double that to estimate a full year, and you get roughly 10 naira 26 kobo in annual earnings per share. Divide the 244 naira share price by that 10 naira 26 kobo, and you arrive at approximately 23 times. That means investors are paying about 23 naira today for every 1 naira of annual profit the company is currently generating. On its own, that isn't necessarily unreasonable. Investors are often willing to pay a higher price for an exceptional business. But that only makes sense if the business keeps moving in the right direction. And that's where this quarter makes that argument much harder. Unlike many of the companies we've analyzed recently, Transcorp Power isn't becoming stronger in a way that justifies its current share price. If anything, the business is moving in the opposite direction. That's a very different picture from the one suggested by the headline profit. Book value tells a similar story. Investors are paying almost 10 times the company's book value. Remember, the company's book value moved from 24 naira 45 kobo to 25 naira 25 kobo. Now, paying a price higher than the book value isn't automatically a bad thing. Exceptional businesses often deserve it. But investors are paying a price that assumes this is an exceptional business. To support a price like that, you'd normally expect to see strong growth, healthy cash flow, and a business becoming stronger over time. This quarter doesn't paint that picture. That makes today's share price much harder to support, based on the numbers we've seen. But that's still an assumption. The financial statements don't prove it. They simply leave the possibility open. So where does that leave investors today? Based on the evidence available in this report, the valuation picture has become much more balanced. After falling by about 20% since the previous quarter, the share price now reflects many of the concerns we've discussed today. That means the stock no longer looks as expensive as it once did. At the same time, it doesn't yet look cheap enough to ignore the risks. So, what's the verdict? For new investors, watch. At 244 Naira, the market appears to have recognized many of the concerns we identified. The stock no longer looks obviously expensive after its recent decline, but neither does it offer enough evidence to justify buying aggressively today. If receivables begin falling and operating cash flow turns positive over the next 1 or 2 quarters, today's valuation could become attractive. Until then, patience is the more evidence-based approach. For existing shareholders, hold but monitor closely. Nothing in this report suggests the business itself is in distress. The company remains profitable, margins remain healthy, and dividend payments continue. However, this is no longer the kind of business investors can simply buy and forget. The next quarterly report becomes critical. Watch 3 things carefully. Does operating cash flow return to positive territory? Do trade receivables begin coming down? Does management avoid taking on substantially more debt to support dividends and working capital? If those trends improve, confidence in the long-term investment case strengthens considerably. If they deteriorate again, today's cash flow warning could become tomorrow's balance sheet problem. For now, the evidence supports holding existing positions rather than adding new ones. That's it for Transcorp Power plc's unaudited second quarter 2026 financial results. If there's one thing to remember from today's analysis, it's this: profits matter. Cash matters more. A company can report billions of Naira in earnings, but until those earnings become cash in the bank, investors should always ask one more question: who's holding the money? For Transcorp Power, that question now matters more than any other. Before we wrap up, remember, this video is not financial advice. It's for educational purposes only. Always do your own research or consult a licensed financial advisor before making investment decisions. Now, I'd like to hear from you. Have these results changed your view of Transcorp Power? Or are you waiting for the Q3 cash flow statement before making up your mind? Let me know in the comments below. If you enjoy evidence-based investing without the hype, like this video and subscribe to Behind the Numbers TV. Also, turn on notifications so you never miss our next deep dive into the Nigerian stock market. Because every number tells a story, and together, we'll learn how to read it. See you in the next video. Thanks for watching.